Hello everyone, welcome to iExamP. In continuation for a discussion for professional knowledge for Bank of India Credit Officer exam for 2022, today we are going to discuss an important topic of working capital management. Banks provide working capital limits to various corporate and businesses. So how do they assess that? What exactly is the working capital requirement of companies? We will discuss that in brief in today's video. So this is an overview of the professional knowledge course, and one of the topics, working capital management, is what we are going to talk about today. So what working capital is, basically it is the capital which businesses or corporates need for meeting their daily working operational requirements. Right, so they need funds to buy raw material, to fund their inventory, to carry on the production process. So till the goods reach the stage of being sold, those operations have to be funded, and that is what the working capital refers to. It is mostly, when we are talking about working capital, it could be both gross or net, but mostly when we are talking about, we refer it to as the net current assets, or also known as the net working capital. So the gross concept can also be there. However, as I am repeating, net current assets and net working capital is what is mostly talked about, which is represented as your current assets less your current liabilities. If we are only looking at the current assets, in that case it is known as the gross working capital. But when we reduce this from the with the amount of current liabilities, what we get is the net working capital, or also the net current assets, it may be referred to as. One other very important concept to understand when we are talking about working capital is the operating cycle. So operating cycle is basically referring to the time, the duration, the period that takes to convert your current assets, which is mostly your inventory and your receivables, your accounts receivables or your debtors, into cash. So how much time does it take for a company when it first buys its raw material, converts it, carry on the production process, sells it to the customers who have taken it not on cash but on credit, and then is actually receiving cash in return? That entire period is known as the operating cycle. It is very important to understand the operating cycles of the company, because it helps to estimate the working capital requirement. For example, if from the raw material till the sales happening, say cash sales happening, if the raw material production stage takes 100 days, then approximately 3.5 cycles in a year it takes for the company to convert its raw material into cash, and therefore it would require funding to be able to fund its requirement for at least 100 days at a one stretch. So this is very simple way of explaining it, but operating cycle is therefore necessary, because if the company is not getting back its cash, till it gets its cash back, it needs funding in between to be able to sustain that duration, which is the operating cycle. So how do banks actually assess? There are three methods which banks use to assess the working capital requirement of the borrower, and therefore on that basis be able to extend the working capital limits. For example, it could be the CC limit, the cash credit limit, which are certain kinds of fund based limits which the banks can give to the companies. So the three methods usually talked about is the turnover method, the Tandon committee method, which gave the maximum permissible bank finance method, and then there is a cash budget method. Let's quickly look at each one of them. The turnover method was actually given by the Nayak committee, the PJ Nayak committee, which suggested this, in which it assumed that a company usually goes through 4 operating cycles on an average in a year. Right, so almost a quarterly cycle a company on a usually basis they are following, and therefore the working capital can be based on the basis of annual turnover. As per this method, the working capital gap or the working requirement which a company has is dependent on the sales per operating cycle. So that's why if in a year we are saying the annual turnover we know, and we are assuming there are 4 operating cycles in a year, as per the committee, the working capital requirement for a company is approximately 25% of the projected sales. So your annual turnover, because there are 4 operating cycles, 25% of your annual turnover becomes the working capital requirement for a company. And then this committee suggested that this 25% should be the minimum, not the maximum, but the minimum requirement which the company may have, which can be funded to the extent of 20% by banks, and the 5% is actually the margin which the promoters or the company itself should bring in form of equity. So this is one of the methods. The second method was given by the Tandon committee, which refers to the maximum permissible bank finance which the bank can give. So this talks about the maximum, while the Nayak committee talked about the minimum funding which a company would require. This committee suggested 3 methods which can be used to estimate the requirement or the bank funding maximum that a bank can give to a company in form of working capital limits. So the first method was related to the working capital gap. And what is the working capital? The WCG refers to the working capital gap, which is basically the difference between your current assets and other current liabilities. Now, what we mean by other current liabilities is your current liabilities less any kind of bank borrowings that have already been used to fund the current liabilities to current assets to some extent. So what are the other current liabilities which the company has? That helps you to find the working capital gap. And if you take 25% of that and reduce it from your working capital gap, that is the maximum that you can fund. Another way, in some books you may find, or in some cases they may say 75% of working capital gap, which is nothing but the same thing as this formula. Here you are reducing 25% to get the maximum, or you can just calculate as the 75% of the working capital gap. The second method is again the working capital gap being reduced by 25% of current assets. So the difference between the first and the second method were, here you are reducing 25% of the working capital gap. However, in this case you are reducing the 25% of your current assets from the working capital gap. Okay, and then there was the third method in which it was also assumed that the companies have certain current assets which are core, so they are permanent in nature, and therefore we reduce them to find the actual requirement of working capital, because this core current assets are always present and are always necessary and are funded by the long term funds. So we reduce them and then try to find the working capital gap for a entity. So understand it better, we'll use an example here. Say for example, if we know that there are total current assets available with a company of 50,000, current liabilities are 15,000, and there is a bank borrowing available already of 5,000, and 10% of the current assets are core current assets. Based on the 3 methods, the bank funding, maximum bank finance that can be available to a company will differ. Under the first method, where we are saying the working capital gap, 75% is maximum that can be funded, the calculation can be like you have the total current assets from which we reduce other current liabilities, and other current liabilities is actually arrived at by current assets minus the bank borrowings, as we had discussed. So basically you are reducing from here the other current liabilities, which gives you the working capital gap as 40%. Now reducing 25% of working capital gap, you get the maximum permissible banking finance of 30,000. So as I suggested before, you could either take 75% of this to directly arrive at this answer, or reduce 25% to come at the maximum permissible banking finance. As per the second method, our calculation of the working capital gap remains the same as before. However, here we reduce 25% of the current assets and not the working capital gap. So in that case, the maximum permissible bank finance is lesser than what it was under the method 1. And if we look at the third method, in the third method, first we find the gap that has to be funded from the current assets. So we reduce the core current assets to arrive at the actual current assets. So those current assets are 45,000. So they have reduced from 50,000 to 45,000. Then we reduce the other current liabilities to arrive at the working capital gap. So our working capital gap has actually reduced. Why? Because this 5,000 of core current assets are already funded through long-term sources, because these are permanent in nature and therefore not to be covered by the working capital. And here then we reduce it by 25% of the requirement of this, the actual current assets that need to be funded to arrive at the maximum permissible bank finance. So this was as per the Tandon committee. The last method is the cash budget method. This is used more in the seasonal industries where there are orders placed in one season and the cash realization is spread around the year. In this, the working capital requirement is assessed based on the projected cash flow in a year, and this is basically broken down into smaller time periods, say for example monthly or fortnightly, depending on the cash cycle of the company. So the company may be preparing its cash budget on a monthly basis and the deficit every month. So in whichever month there is a peak cash deficit, that becomes the extent to which the banks may be providing the funding. So here the banks are basically understanding the capital needs based on the cash deficit that the company faces during a year, and whatever is the maximum, they may look at funding that through the working capital limits. So these are the three methods which the banks may be using. Let's move on to some Q&A that can be helpful for your exam. First question: management of working capital deals with what position of the company? It is the short-term liquidity, the long-term liquidity, the short-term solvency, long-term solvency, or all of the above. The correct answer here is A, short-term liquidity. So the working capital management mostly refers to the short-term working capital requirements, which is necessary for the company to work smoothly in a liquid fashion to manage its liquidity, to manage its cash position in the company. Second question: the projected annual turnover of ABC Limited is rupees 100 lakh for the current financial year 22-23. According to the turnover method, what will be the working capital that is to be financed by the company? So we know that as per the turnover method, the minimum funding that is required is 25%. However, the financing that needs to come from the company itself is 5% and 20% can come from the bank. So this 25% is broken into this. So 5% is what can be funded by the company. So the correct answer here is 5 lakh. So you can also practice free mock tests on iExamB's website, where you will get exam like mock test to practice, including all the 3 sections of English, professional knowledge and general awareness as per the exam pattern, as per the level of the questions asked in the exam, which are available for free. So you can go on the website and find the mock test for Bank of India Credit Officer. Moving on to the next question: what does M in MPBF stand for? So we had been talking about this method that was given by the Tandon committee. So what does the full form of this acronym is? Is it minimum, maximum, medium, mezzanine, or micro? Correct answer is maximum. MPBF stands for maximum permissible bank finance. The Tandon committee, which gave the recommendation of the MPBF for working capital finance, so it was associated with Mr. P.L. Tandon. Okay, so he was the chairman of this committee which came out with this recommendation. So he was the MD and chairman of which bank? Is it State Bank of India, Punjab National Bank, Canara Bank, Indian Bank, or Bank of India? The correct answer is Punjab National Bank. If you want to see the type of questions that have come in Bank of India Credit Officer in the last recruitment cycle of 2020, again you will find the memory based paper for the last two recruitments, 2018 and 2020. All the questions available on a memory based paper. Again, you can go and attempt them to see the pattern and the level of questions that have been asked. This is also available for free on our website. Last question for today. Which of the following is not a current asset? Raw material inventory, finished good inventory, sundry debtors, accounts receivables, or none of the above? Which of this is not a current asset? You can write the answer in the comments box and I will reply it in the comments box after seeing your answers what the correct answer is. So ongoing classes at iExamB for the preparation of Bank of India Credit Officer. You can see the schedule on your screen. We are almost halfway through for the important topics that are relevant for your exam preparation. Today the class is going to be on ratios and analysis, and this is the schedule of all the other upcoming classes in this month. Thereafter, as depending on the date of the exam, we will continue to have revision classes and practice classes for the exam. The faculty is experienced and knowledgeable. For professional knowledge, we have Shikha Ma'am, who is ex-Deputy Manager, State Bank of India, with 10 years of experience in the banking space across departments, including credit and risk. Myself, Prachi Agarwal, I am the ex-manager of Care Ratings with 10 years of experience in the financial markets on the equity and the debt side, and 4 years of experience of preparing for various government jobs on the finance side at iExamB. We have Neha Ma'am, who is an academician with more than 5 years of experience of teaching finance and accounting subjects for various government job exams preparation. For English language, we have Arunima Ma'am, who's an ex-manager SIDBI and been coaching for bank exams for more than a decade now. Manali Ma'am with more than 7 years of experience. For general awareness, we have Sushil Ragre sir, ex-manager RBI, and Amit Padi sir with more than 5 years of experience on guiding for GA preparation. So in case you want any more updates regarding or details regarding the credit officer course for Bank of India, you can reach out to the number that is available on the screen. Thank you everybody. Wishing you all the best for your preparation. Don't forget to subscribe to the channel for any further updates related to Bank of India Credit Officer.